We work on a digital ruble. We decided to create a prototype, and we hope that this prototype will be ready by the end of this year.
The Federal Reserve CBDC could pose significant and concrete risks.
Is inflation just at the moment, or in other words, transitory, or will it be enduring? And I at least think there's a material risk that could be enduring, and I think that policymakers should act accordingly.
We're very likely to be in a position on July the 19th to say that that really is the terminus, and we can go back to life as it was before COVID.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Wall Street's big banks rewards investors after passing the Fed stress tests. Morgan Stanley, Goldman Sachs, JP Morgan, and Bank of America boost dividends. The Delta variant sends more than half of Australia into lockdown, while Hong Kong bans flights from the UK, and Spain tightens up the travel restrictions. And Facebook's market value surges past $1 trillion after it won the dismissal of two separate U.S. antitrust cases. So happy Tuesday, everyone. We have a really packed show for you. To our top market story, and the biggest U.S. banks are boosting payouts and continuing buybacks after clearing the Fed stress tests. Among the highlights, Morgan Stanley doubling its quarterly dividend to 70 cents. Goldman Sachs actually increasing its payout to $2 a share. Now, one Wall Street firm stood out as an outlier. Citibank actually elected to keep its payout as planned. So let's get the very latest with our Danny Berger. So, Danny, Morgan Stanley really looks to be the standout when it comes to capital distribution plans.
Yeah, absolutely. Doubling what they're going to give back to investors in terms of dividends. And that compares collectively to about a 40% increase in their payback to shareholders. So definitely that's why we saw Morgan Stanley rally about 2% after the close yesterday. So that's really the bright side. Their yield now is about 3.2%. So it stands to reason why anyone who's searching for that yield would want to go and buy Morgan Stanley. So if that is the good picture, the bank you'll see missing from this board, with everyone ranging from 11 to 100% increase, is Citi. And that's because, as you say, they decided to keep their dividends as is. Now, their stock slumped a little bit after market. They have to increase their capital buffer. And of course, if you're doing that, that means there's less money to pay back. They still have a decent yield, so it's not like this means all-out panic at Citi. But again, it's just not shining as bright as someone like Morgan Stanley.
Elsewhere, of course, there's a new Bitcoin ETF filing from Cathie Wood's ARK Capital Management. The SEC, Danny, still hasn't approved or still isn't approving Bitcoin funds, though, are they? Yeah,
they're definitely not. But the fact that we're seeing more people get involved, especially someone who's such a big Bitcoin proponent as Cathie Wood's, shows that there's anticipation that this might happen in the near future. And if you're ARK Capital Management, you don't want to get left behind. So this specific one, it's actually not sponsored by ARK. It's sponsored by someone called 21 Shares. They're in Switzerland. There's a lot of Swiss ETPs around crypto that they put out, so it makes sense that they're the ones doing this. ARK is signing on as the marketing function of this fund. So their name, ARK, gets put into the name of the ETF. They're going to do all the marketing for it. Again, it's a question mark when or if this will be approved. As it stands, there are about 14 or so other filings for a Bitcoin ETF in the U.S., Francine.
Danny, thanks so much. Our Danny Berger there with the very latest on some of these cool things happening in the markets. Now, for more of the market action today, let's get straight to Bloomberg MLive's Eddie van der Walt. Eddie, I know a lot of the focus, of course, is what's going on with the Delta variant and the fact that it could infect more markets.
Yeah, absolutely. You know what? These stocks are continuing to push at record highs, but at the same time, there's just this underlying fear still in markets. So over a number of things, as you say about the Delta variant, which is raging in many places, including here in the UK, but also about, inflation or a policy mistake. Just in the last couple of days, we've just seen more people raising the specter that potentially things have gone too far. Potentially markets are starting to get a bit bubbly. Ray Dalio talked about that. And if you look at the SIBO fear index, that's pushing at record highs too. The skew indexes, people are paying up for options protecting against a significant sell-off.
So, Eddie, the chief executive, I don't know whether I should ask you about meme stocks because I also want to ask about the football, but the chief executive of IG Group says that meme stocks are just a passing fad.
Our view is that the meme stocks will come and go because it is a social media trend. we're looking at is making sure that people get the right information around responsible and appropriate companies as opposed to just trading on fads.
I mean, is it a passing fad, Eddie? It's unclear to me, actually, what they'll become, because you see GameStop now entering the kind of, the big league.
Yeah, I saw. Look, I think this is interesting. I think what the real question here is, we saw a lot of new players entering the market during the COVID crisis, during lockdowns. They suddenly had money at their disposal. They were locked at home, and we saw people, retail investors, a new wave of retail investors coming into the markets. They were younger and they're more engaged in social media. Is that going to end when everybody's back in the office? I'm not sure it does. I think, because I think this trend is older than just COVID. I think this trend started with younger investors buying Bitcoin and those kind of shares. So I'm quite excited. I think we are seeing, perhaps not, perhaps meme stock isn't the best thing to come out of this, but I do think there's a social media engaged younger audience, and they're trading shares.
All right, Eddie, please tell me you watched the football yesterday.
What football? There was football on? Sorry, I really don't know.
Yeah, my husband also stopped.
I could talk to you about Wimbledon, though. Wimbledon was great.
I know the standing ovation was actually, something that brought a lot of tears to a lot of people's eyes. Eddie, thank you. Bloomberg, MLive's Eddie van der Walt there with some of the main market stories. Now, a commodities boom makes traders and hedge funds billions as the world economy recovers. How much further does the boom have to run? Up next, we discuss today's big take with Javier Blas. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. UK house prices grew at their fastest annual pace for more than 17 years in June, according to data from Nationwide Building Society. Values were 13.4% higher than a year earlier after a third consecutive monthly increase. Demand has been fueled by people seeking more space outside urban areas, borrowing costs near record lows, and a temporary government tax break. Now, a new study has found mixing doses of COVID vaccines from Pfizer and AstraZeneca creates a strong immune response. The University of Oxford research could enable greater flexibility in the use of scarce supplies. A mixed schedule of the Pfizer jab followed by the Astra vaccine and vice versa resulted in high concentrations of antibodies against COVID-19 when given 4 weeks apart. Now, Facebook has won the dismissal of 2 U.S. antitrust cases after a judge ruled the government failed to establish the social network has a monopoly. The lawsuits were brought by the Federal Trade Commission and a coalition of states who claimed Facebook violated antitrust laws by buying Instagram and WhatsApp. The plaintiffs have 30 days to refile their complaints. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, from steel to soybeans, commodities are back in fashion for the first time since before the global financial crisis, bringing huge returns to hedge funds and traders. Some are talking about this as the 5th commodities supercycle in modern history. As the world economy emerges from the pandemic, how much further does the boom have to run? Well, joining us now is Bloomberg's chief energy correspondent, Javier Blas. Javier is, of course, co-author of The World for Sale, Money, Power, and the Traders Who Barter the Earth's Resources. Javier, thank you so much for joining us. You have this fantastic piece out, which is a really big take, of course. So are we actually in a 5th super cycle for commodities?
certainly prices are at levels that in the past we have associated with commodity super cycles. It's not just one or two commodities. It's a broad spectrum of raw materials who have risen considerably at some point, in some cases up to record highs. So it's across metals, agriculture, and energy. Whether this is a new super cycle, the fifth in modern history in the last 100 years, or is a continuation of the super cycle that China really started about 15, 20 years ago with his urbanization and industrialization, is a matter of debate. But certainly prices are rising, they're across the board, and they're indication that prices are going to remain at elevated levels, perhaps not at record highs, but really at a higher than usual levels for some quite a time from now. So that kind of gives credence to the talk of a commodity super cycle, again, ongoing.
So, Javier, who have actually been the main winners so far?
Well, the commodity traders, for sure, the companies that actually buy and sell physical commodities, these are the companies like Glencore, Vitol, Trafigura, or Cargill. They have done very well. They did well last year already on the way down when prices crashed, but they have done fantastically well on the way up. In some cases, they have reported the largest ever profit, and the numbers that we are seeing for 2021 are looking spectacular. With 6 months, in only 6 months, for example, Trafigura made more or less as much as he made on his best year ever. So that kind of gives you a sense of how profitable the increase in prices is for the traders, and not only the increase in prices, but also the increase in demand that is coming alongside. And then the commodity hedge funds have been doing in general quite well. They were very popular. They were in fashion in 2006, 2008. Then people kind of fell out of love from commodities, but they are back, and in some cases, commodity hedge funds are up as much as 50% year to date. So that's another pocket of winners for these upswing in commodity prices.
So, Javier, how much actually will be used, of these commodities will also be used for the energy transition?
Well, this is one problem that we may be facing, because some of the commodities that we are going to need for the energy transition, think about the metals that go into batteries or copper that is needed for the electricity grid. The prices are very high, so that is going to mean that the energy transition is going to be a bit more expensive. On the other hand, energy is going up. Oil, coal, natural gas, coal and natural gas prices in Europe are at the highest level in 10 years. So that means that wind power and solar power became more competitive price-wise against them, and then probably more popular. So there are some headwinds for the energy transition because of high commodity prices, but there could be also some benefits. But in general, when governments are pushing for a big transition and that transition is inflationary, that is a problem, because no one wants to really tell consumers, we're going to do this transition, and that's going to mean that it's going to be more expensive for you. That's a recipe to lose an election.
Javier, where do you see OPEC, and actually where do you see the price of oil going?
Well, at the moment, we see OPEC really in control of the oil market. They face some headwinds. Iran is going to be coming back at some point over the next few months if there is a deal with the Americans, a nuclear deal. And certainly the Delta variant or any other subsequent variant of COVID is a concern for OPEC. But they seem to have the market under control. Saudi Arabia, with the help of Russia, is increasing production very slowly, always production behind the demand. So I think that the Saudis probably have the market under control, and they are creating a floor around $70. The key question is how much OPEC will let prices go. And in general, OPEC is very quick at defending the downside, but it's not very quick at capping the upside. So I will say that prices are quite well supported at current levels, with the risk of higher prices if the economy continues to recover.
Fabulous. Javier, thanks so much. That was Bloomberg's chief energy correspondent, Javier Blas. Now, if you want to read his big take in full about commodities and the commodities boom, just type NI Big Take Go. Now, up next, we speak to the chief executive of an e-commerce platform in the sporting goods space, Signa Sports United. Stefan Zoll is on shortly. We'll discuss the recent Ron Burkle-backed SPAC deal. Stay tuned. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's turn our attention to the e-commerce space. Our next guest is the chief executive of Signa Sports United. Now the company is an online sports goods retailer with more than 7 million active customers, specializing in cycling, tennis, and camping gear. Earlier this month, the company agreed to combine with billionaire Ron Burkle's SPAC in a deal with an enterprise value of about $3.2 billion. Well, we're joined now by Stefan Zoll. He's the Signa Sports United Chief Executive Officer. Welcome to Bloomberg, Stefan. First of all, congratulations on various deals and, of course, on your listing in New York City. Why the NYSE and not somewhere else in Europe?
Great, thank you, and good morning, Francine. Thanks for having me. So why the New York Stock Exchange? Because we're actually expanding into the US over the next years to come, especially in our tennis and our bicycle vertical. And doing the SPAC route also is an advantage, that's obviously largely common now in the US, because we're a growth company. We've come from a strong growth track record over the last years, and we'd love to talk about that growth in the future, and that's something that the SPAC route allows us to do. And on top, we also have been acquisitive in the past. And then also the SPAC route allows us to kind of do an acquisition at the same time as we do an IPO. So we market the two companies on a pro forma basis together. And those two are great examples and great advantages for us to go there.
Stefan, can you talk to me a little bit about how you think the pandemic has actually impacted our love for sports and specific sports? Has it changed the way that we consume and also do sports?
Yes, that's a great question. So what we see in the market is that actually people have been more active than they have been pre-pandemic. And maybe just one number, right? In the US, 8 million more people have been actively participating in sports or outdoors activities versus 2019. So within the Corona year, actually, more activity has been done. And also in tennis, for example, we see 4 million new customers or new active players basically in the US tennis cycle to have joined that tennis circuit. So that's actually very promising that people became more active.
So how do you see it changing? I know, I was reading that you're now also selling some of the products of the Tour de France. Does the love of certain sports changed? And what changes? Is it the people that are playing it? Is it, what you see on TV? Like, why do I like Wimbledon one year and maybe Tour de France in the following years?
Right, so I think you see that people are getting more interested in those types of events overall, right? And Tour de France is obviously a great example. I mean, we are, as you said in the beginning, we are in 4 categories. We're in cycling or biking, we're in outdoors and tennis, and also in team sports. And in cycling, Tour de France is the one big mega event, right? So people are watching it. It's a great, great thing. And we are actually the distributor for the Tour de France merchandise exclusively in France right now, and do a lot of spectacles around it. So, for example, we have a shop in Lyon, right, at the heart of France, where we have an event on the 3rd of July, inviting people to come to basically participate in this great sports activity and in this great event.
How much do people typically spend actually on your website? Is it, a lot of customers that buy very little, or is it, big ticket items for fewer customers?
Yeah, so it's basically, we talk about AOV, right? Average order value. So that's the general ticket size of one order. That's very high. That's above $120 that we have. So it's rather the bigger ticket items, less the smaller items. And it's rather less frequent. So not like every month, right? You don't buy a bicycle every month. You don't buy a tennis racket every month. But we see a very nice frequency. And what's so particular in our business is with these high basket sizes, we see people retaining a lot because we've been specializing on really catering for the needs of a sports enthusiast in tennis or a sports enthusiast in bike. And if you do that, people really are satisfied with your customer experience, and then they come back. And hence, over the life cycle of a customer, many, many years, we see them coming back, very, very frequently over that life cycle.
Stefan, does the word SPAC actually help with investors? Is there more questions and is there more appetite to find out who you are because it has the word SPAC?
Well, I mean, I don't know if the SPAC word is so critical, right? UKIPA is certainly a great partner for us, right? I think Ron Burkle is a big name in the US and globally. So we're very happy to partner with him and his SPAC. But as you know, the investor community, SPACs have been around quite a long time now. And I think it's just one other area, one other tool in the toolbox of going public, which is commonly, known and accepted and a good way to do it. So I don't know if the word itself is drawing a lot of more attention, but certainly we're very happy to be part of UKIPA and Ron Burkle's area now, and think we have great promises ahead.
Stefan, thank you so much. Stefan Zoll, their Cigna Sports United Chief Executive Officer. I have to say, Stefan, as a disclaimer, in the Lacqua household, a couple of premium bikes have definitely entered our front door since the lockdown started about 14 months ago. There you go. Coming up, bumper payouts from Wall Street. Big banks boost cash returns to investors after passing the Fed stress test. We'll check in on the pre-market reaction. Then we also have a look at what's happening in the world of commodities. We had a fantastic briefing by our very own Javier Blas. The one story that's also capturing a lot of our imagination is the fact that UK house prices are surging the most in 17 years. That's according to Nationwide. This is Bloomberg. Wall Street's big banks reward investors after passing the Fed stress test. Morgan Stanley, Goldman Sachs, JP Morgan, and Bank of America boost dividends. The Delta variant sends more than half of Australia into lockdown. Hong Kong bans flights from the UK, and Spain tightens up travel restrictions. And Facebook's market value surges past $1 trillion after it won the dismissal of two separate antitrust cases. Well, good morning, everyone. I'm Francine Lacqua in London. I've been screaming too much at the football, which is why I'm losing my voice day in, day out. A Bloomberg Surveillance early edition on this Tuesday, the 29th of June. Now let's get straight to Danny Berger, who's looking at how banking stocks are faring this pre-market session. Hi, Danny.
Hi, Francine. I'm kind of worried about what screaming might be going on in the Lacqua household with the England-Germany game. I know there's going to be a lot happening at mine, so definitely get some tea, Francine. Look, when it comes to these pre-market movers, the banks, of course, are in focus. They all passed the stress test. This was largely expected, so we expected them to be giving back dividends. And part of the interesting thing here is that we're getting movement despite many people saying this was already priced in because of the good results. But I don't think many people expected a doubling of the dividend from Morgan Stanley to $12 billion rather in buybacks. James Gorman really emphasizing the strength of the Morgan Stanley balance sheet. Now, I should say, even though this one is higher in terms of trading volume, we're seeing 10 times as much pre-market trading volume in Citigroup, which is only trading 0.4% lower. But again, there is just more action happening below the surface there. Citi keeping their dividend at 51 cents. They did say they were going to plan to give back as much as regulation would allow, but still didn't detail what their share buyback plan would look like. So maybe a tinge of disappointment there. Again, it's not huge because, of course, they still have a buyback. Their yield still looks pretty strong. But I would say this is really a case of outstanding results, and for the rest of the banks, more or less meager results, Francine.
Danny, thank you so much. Danny Berger there with the very latest, of course. And the next step is to see what European banks can do about it when they're allowed to, and how they actually compete on the payout front. Now, AZA Finance is now the largest non-bank FX firm in Africa following its takeover of South Africans Exchange for Free. The acquisition more than doubled the annual value of AZA Online's transaction to more than $2.5 billion. Now, the company says that by boosting trade in currencies on the continent and between nations, is seeking to boost intra-Africa commerce. Well, joining us now is Elizabeth Rossiello, AZA Finance Chief Executive Officer. She founded the firm 8 years ago and created currency pairs between some of Africa's lesser used currencies. So, Elizabeth, thank you so much for joining us right here on Bloomberg Surveillance. When you give us an idea of actually the acquisition of Exchange for Free, how has that integration worked, and what does it mean for your expansion across Africa?
Sure, and thanks for having me here, Francine. When you're talking about payments and foreign exchange across the African continent, the story is really about infrastructure. So every time you enter one of the 55 markets, to be able to make a market in that currency pair or trade cross-border, it's all about having a license, having deep relationships with the banking infrastructure, having connection to the API last mile, and then, of course, the clients and the revenue. But the infrastructure comes first. So this acquisition in South Africa is an acquisition play, an infrastructure play, and it helped us get right into the market with deep infrastructure, some of the best in the business, and take over some of the key clients in South Africa.
So, Elizabeth, has it actually enabled you to do things that you couldn't do before?
Yeah, of course. Now we can make a market in ZAR ourselves. Before acquiring this company, the South African rand was very hard to access, given the monopoly on some of the brokerage licenses that are down there. So really to be able to get into the market and have a license and have a partnership with a local financial institution to be able to make the market ourselves straight off our balance sheet helps us lower the costs and ease the transaction ability between the South African rand and other African markets. So if you look right now, it can be up to 19% for companies, large travel companies, large payment companies, to go between South Africa and Nigeria. And remember, Nigeria is the 7th largest country in the world right now, according to population. It's a huge market. And to not be able to trade efficiently and effectively between two of the largest markets in Africa seems insane, but it is the case. So by us entering into the South African market and adding it to our infrastructure, we're able to lower the cost dramatically, increase the speed, and of course, reduce friction.
So, Elizabeth, how's your expansion plan? Or, I know I think set your eyes on also the Middle East and certain parts, including Egypt. When will that happen? Is this the next step, or will you take a little bit of time?
No, we're ready to go. I mean, we've been 8 years in the market building, and I think we have the formula down on how to enter the market, how to make the pair, how to expand the team and scale the operations efficiently. We have a centralized platform of compliance and trading. So adding into new markets is part of the plan. It's part of the model. We've been active in Abu Dhabi, which of course had its arms wide open for fintechs for a few years right now. But I think going deeper into the market, into Dubai, is essential. And in Egypt, we'll be launching in Q4 through a partnership, but in both markets, we're looking to acquire it as well.
When you see, Elizabeth, I guess the way that we look at the markets has changed. This can be because of retail investors. It can be with a lot of things. Does it help actually the case for AZA? Does it change the way that, you think the marketplace will operate in 4, 5, 6, 10 years from now?
Oh, definitely. And I wrote about this for the World Economic Forum, where I work actively to promote south of the border or trade south-south. I mean, what we've seen in the last year and a half with COVID has been an awakening of large clients to come away from the practices and policies and partners that they are familiar with and go to what maybe works better. So I think we had a hesitance among global treasurers and Fortune 50 to try something new, and they couldn't understand to do a couple $1 million transaction with what they would call a startup. I mean, technically, I'm an 8-year-old growth company, but in this day and age, if you're under the age of 60 and your CEO, looks like I do, I guess you're still in startup territory. But we're trading billions per year, and we're the new partner, we're the new counterparty. So I think COVID-19 reduced the reluctance of a lot of large companies to try something different. And in a lot of ways, a lot of the banks went offline. We saw in the heart of lockdown, all of the Nigerian banks really struggled to get their staff to log online. I mean, even us, we had to allocate energy credits and, send out computers and infrastructure. And we're used to being a distributed company with a lot of staff working remotely. Even for us, it took a little bit of time. But for the rest of the banking infrastructure in a lot of these markets, their team had never worked from home. They had no idea how to manage that. So trading stopped. And, we saw a real slowdown in the way payments were processed and new customers were onboarded. So I think that really broke down a lot of barriers.
Elizabeth, do you see, who's your biggest rival? Who do you consider your biggest rival? And actually, do you think you'll get approaches by some of the bigger banks to, try and buy you out?
So it's still very fragmented across the African continent. You have real champions maybe in each corner of the continent: Northern champions, Western Anglophone, Western Francophone, Southern African, East African, but you don't really have one global champion across the entire continent. And so for us, we compete locally with partners that are strong maybe in that one market, but the second that a client needs to operate in more than one market, they come to us. So they might have a great partnership in Senegal, but if they don't have a partner in Ghana, it doesn't make sense for them to have counterparties everywhere. So we really provide that quilt, that patchwork quilt across the entire continent, giving the same quality of service, the same level of speed, and a real attention to detail when it comes to integrating their technology. And so, it's hard to say we don't have a competitor. We have many competitors in each market, but nobody's doing the cross-border and the Pan-African the way we are.
Elizabeth, thanks so much. Elizabeth Rossiello there, AZA Finance Chief Executive and Founder. Now, coming up, the instrument upon which the financial world is built is due to expire starting at the end of this year. But what will life look like after Libor? We discuss that next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Garrett. Hi, Leanne.
Hi, Francine. UK-based buyout firm Bridgepoint is planning to raise about £300 million listing on the London Stock Exchange. The IPO would see a rare private equity stock join the market amid a global rush for listings. According to the FT, the offering could value the company at about £2 billion. Now, Cathy Wood's ARK Investment Management is the latest company to file to create an exchange-traded crypto fund. If approved by the SEC, the ETF will track the performance of the world's largest cryptocurrency as measured by the S&P's Bitcoin index. So far, there are around 10 Bitcoin-related ETFs filed with the SEC, which last week postponed a decision to approve one of them. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now, the end of Libor is certain. The instrument upon which the financial world is built is due to expire starting at the end of this year. That will actually force some $300 trillion of securities to find new benchmarks. But what remains uncertain is exactly how markets will fare in a post-Libor world. So how did we get here? Well, here's why Libor is so important.
Well, Libor is part of the essential plumbing of the financial system. It's not terribly sexy, but it is terribly important. It's been called the world's most important number because it helps determine the interest rate on about $300 trillion worth of securities, including mortgages, loans, and derivatives.
The system is broken and needs complete overhaul.
Beyond these disclosures that the Libor system is structurally flawed.
What happened is that an explosive growth of derivatives in the 90s and 2000s meant that increasingly banks' profits were determined by whether Libor went up or down every day. And so you had this real incentive for banks to lie about their borrowing costs.
It wasn't just done for profit, though. During the 2008 financial crisis, people started looking at banks' individual Libor submissions as a gauge of their creditworthiness. And what you found was that banks were lowballing their submissions so that they were more in line with their peers.
So in 2008, you start to see articles questioning the veracity of Libor. And then you get regulatory investigations. And so in 2012, you start to see some of the world's largest financial institutions fined billions, in some cases billions of dollars for their part in this scandal.
We have to operate on the proposition that Libor is likely to go away. And I would even go a bit further than and say it should go away because it's not supported by a sufficiently robust regime.
The regulators forced the banks to change how they did business and also started the process of transitioning to another rate.
Here we are today in 2021, and that process is still ongoing.
Our reporters Gavin Finch and Liam Vaughan, they're co-authors of a book about the Libor scandal called The Fix. Now, joining us for more is our Libor reporter, Will Shaw. Will, great to have you on the program. I mean, I've been to a number of events over the last 3 to 4 years saying, guys, it's the end of Libor, be prepared. And this was regulators speaking to the banks. Why is it just so hard to wean the world off Libor?
Well, so even as the clock is ticking down, there's still, it remains, like Libor remains deeply entrenched in global financial markets. So in derivatives alone, it's still linked to about $200 trillion worth of instruments. You'll find it linked to mortgages, securitizations, loans, credit cards, all kinds of assets. Now, it's been particularly problematic in loans. In derivatives, it's less of a problem, and that's partly because there's a system in place that will automatically transfer an awful lot of those instruments over to replacement benchmarks the moment that LIBOR ends.
So, Will, what exactly are the replacements for LIBOR?
So in the UK, you've got a rate called SONIA, which has been around since 1997. Now, in the US, you've got the secured overnight financing rate, which in comparison was only introduced in 2018. And that's made things quite a bit more challenging. Problems have emerged in the US with there's been a delay for 18 months, so LIBOR is being extended until mid-2023, key dollar tenors.
Which means that there's a mismatch, right? How hard is it to find one benchmark to kind of rule them all like LIBOR was? And if the transition in the US is such a problem, what does it mean for the rest of the world?
Well, what's happening in the US is that you're seeing a range of different LIBOR alternatives which are beginning to compete against SOFR. Now, it should be said that regulators broadly are not happy with this situation. Now, one of the reasons that is happening is because although LIBOR's reputation effectively lies in tatters and there are big questions about its integrity, people still like it. And there's a couple of key reasons for that. First of all, it's got what's called a term structure, which means that borrowers and lenders both know in advance what interest rates are going to be paid. And secondly, it has a credit component, which banks think means that it better reflects the risks they take on when they lend to companies. Now, because of those, because SOFR hasn't been able to offer those kind of services, people are increasingly interested in a series of rates known as credit-sensitive rates, which are now fast emerging.
So, well, July 26th, a key date for SOFR.
Yeah, that's right. So what's happening on July 26th is an initiative which is known as SOFR First, which regulators are hoping will finally get things moving into SOFR. Now, what's happening is interdealer brokers are being recommended to shift their swaps trading into SOFR. And the hope is that if they do that, liquidity will quickly build up in SOFR, and then it may be possible to introduce a term rate for SOFR very soon after that happens. Now, the hope is that would address, the hope of regulators is that would address this existential problem that SOFR has, in that it doesn't reflect long-term interest payments.
Great. Well, thank you so much. Our LIBOR reporter there, Will Shaw. He'll also be hosting a panel at the LIBOR Transition Talks conference held here at Bloomberg today. Now, disclaimer, the Bloomberg Short-Term Bank Yield Index, an alternative dollar LIBOR, is also administered by a subsidiary of Bloomberg LP, which is the parent company of Bloomberg News. Now, coming up, Facebook wins the dismissal of monopoly lawsuits, sending its shares soaring, pushing the company's market value to more than $1 trillion. More on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Facebook shares have soared, pushing the tech giant's market value to more than $1 trillion. It follows a court ruling dismissing 2 monopoly lawsuits that sought to break out the company, dealing a blow to the effort of antitrust officials to take on the big tech platforms. Now, for more, we're joined by Bloomberg Quick Takes, Alex Webb. So, Alex, thank you so much for joining us. First of all, is this game over for the antitrust complaints against Facebook?
Not quite yet, no. This is a sort of almost a stay of execution for the FTC. The thing here, they've been given 30 more days to try and demonstrate that Facebook has the scale, the control over the social media landscape. And so, given that it does have something like 2 billion users across its various apps, it seems like there is a chance for them to get back at this, and perhaps it's sort of semantics at this stage. So the price bump yesterday, 4%, not to be sniffed at, clearly dipped it over that kind of imaginary line of $1 trillion. But in the grand scheme of things, I think Facebook still trades at a discount, and there is something being priced into there in terms of skepticism about the antitrust threat.
So, Alex, what exactly is being investigated here?
So it's to do with Facebook's acquisition of WhatsApp and Instagram 8-9 years ago. At the time, the suspicion is they didn't really consider the addressable market properly. They, in this instance, being the regulators. And did Facebook sort of play catch and kill, i.e. buy the competition rather than try to actively compete with it? There are emails that suggest that is the case. Whether that has given Facebook a dominant position when they ought to have got it, that's the thing that's really at question.
What does this say in general about antitrust legislation?
I think it's interesting that this suit was filed before Lina Khan became the head of the FTC. She is the woman who said that actually we think about antitrust in the wrong way, or the US thinks about antitrust in the wrong way. It thinks too much about the impact on the consumer. There isn't really, Facebook is free at the point of service. The market that it actually charges for is advertising technology. So it's sort of begging the question, if this is being dismissed on this basis, is the antitrust legislation fit for purpose? I tend to think maybe not. That's something that they are trying to push through new legislation to fix, so that you think about it a little bit more cosmically and not just in terms of the impact on the consumer, the person using it at the point of service.
Alex, in general, how much do we understand currently about how aggressive the Biden administration could be with some of these big tech giants?
Well, the appointment of Lina Khan as head of the FTC certainly has given some of the big tech critics hope that they will address these issues properly. Lina Khan she's quite young. She's 32. She's a sort of wunderkind, wrote a seminal paper called The Antitrust Case Against Amazon, which encouraged us to think in a different way, to think not just about the impact on the consumer, but actually the control they have over the market as a whole. And so with that in mind, there is a real expectation they start to, be a little bit more forceful with these huge, huge companies.
Alex, thanks so much. Our Alex Webb there with the very latest, of course, on some of the investigations and, of course, some of the valuations as well for some of these big tech companies. Now, let's check on the markets. There is quite a lot going on in the markets because we seem to be repricing a little bit of the Delta variant. Now, if you live in London, you will have heard about the Delta variant for quite some time. Because of the Delta variant, there was a delay in reopening of the economy. This is very clear that the Delta variant actually spreading to a lot more countries is unnerving some investors. I'm looking at the Treasury yield pretty much flattened amid this month-end index rebalancing. The break in auctions until July 12th, then oil slipping, gold heading for the biggest monthly drop in more than 4 years. Now, we spoke to a number of analysts and, of course, market participants. One strategist, for example, from JP Morgan was saying that the Delta variant has also emerged in client conversations as a potential threat to reflation and inflation. One of the other things to watch out this week, of course, we hear from the Chinese president, Mr. Xi Jinping, delivering a speech as the nation marks the 100th anniversary of the founding of the Chinese Communist Party. That's on Thursday. Also Thursday, OPEC Plus meeting, so watch out for any kind of news on oil. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin. Kailey Leinz out of New York. We'll have a full roundup of also some of the Bitcoin ETF news that could come out of ARK Investments in the U.S. We'll look at some of the other things, including the big bank payouts after Wall Street. The main Wall Street banks actually passed everything with flying colors. This is Bloomberg.
We don't see that inflation acceleration is not transitory, as in many other countries, but more persistent.
Is inflation just at the moment, or in other words, transitory, or will it be enduring? And I at least think there's a material risk it could be enduring, and I think that policymakers should act accordingly.
Inflation is like toothpaste. Once it gets out, it's very hard to put it back in the tube. So we have to be super sensitive.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
Well, it's 10 a.m. here in London, 11 a.m. in Berlin, 5 a.m. in New York, 5 p.m. in Hong Kong on this Tuesday, June 29th. Our top stories today. Wall Street cash cows. The biggest U.S. banks boost their dividends and increase buybacks following stress test success. Facebook reaches a milestone. The social network's now worth $1 trillion after a judge dismissed government monopoly lawsuits. And making a killing in commodities, raw materials boom means hedge funds and traders are bringing in billions. How long will that last? Well, it's a pretty packed show today on this Tuesday. Kailey, what's interesting is actually we need to look at the Delta variant. We've been talking about it, certainly here in the UK, for weeks and almost months. It's been over 2 months that we heard about it, originated in Asia, but now it's actually filtering through the markets because people worry it could change inflation outlook.
Yeah, and the growth outlook, importantly, Francine, and that definitely was weighing on markets in the Asian session. Broadly speaking, Asian Pacific stocks were lower. The MSCI Asia Pacific Index fell for the first day in 6, and benchmarks pretty much everywhere you look were lower. The Kospi, the Nikkei, the Hang Seng, and the CSI 300 in China all ending the day lower in China by more than 1 percentage point. And it's weighing on emerging Asian currencies as well. The concerns about the Delta variants. You have a lockdown in parts of Indonesia that weighed on the Indonesian rupiah, which is weaker against the dollar, as is the Thai baht. But broadly speaking, it is a stronger dollar story in the G10 space today. The Bloomberg Dollar Spot Index higher for a second day. And when it comes to other U.S. assets, of course, we did see tech stocks powering equities higher yesterday. The NASDAQ 100 ending the day at a record high. Today, though, giving back some of those gains. Futures off about 0.2%. Not a lot of movement in the Treasury market. We're steady at 1.48% on the 10-year yield. But in the commodity complex, a few things I wanted to note. First of all, oil taking a sharp leg lower just minutes ago. WTI down 1%, approaching $72 a barrel. Concern there about the Delta variant and the impact it's going to have on demand potentially. And then the other thing I have to note, it is really, really hot in many parts of the U.S. That is feeding into drought concerns about crops and that supply. So that is sending crop prices higher. Wheat futures, spring wheat, which is what is used in bagels and pizza, very important for my diet, Matt. Those are at the highest prices since 2013.
Yeah, commodities prices are something we're going to talk about, Kailey, because, you know, it looked like they were turning over. Now they could be coming back. Are we in the middle of a super cycle? Is this, you know, a longer super cycle? We have a great interview coming up with Javier Blas, who wrote The Big Take today. I want to show you what's going on in European markets. You can see we have kind of a mixed trade, although for the most part, equity indexes are up across Europe. If you look at the breakdowns regionally, you will see that Germany is doing the best today with the DAX up more than 0.5%. I also note that among European currencies, the pound, England is doing the worst. Maybe that has something to do with the match later on tonight. Probably not. But you can also see live hogs ripping face up 3%. The biggest mover of all of the commodities traded across Europe. And live hogs have been very active and very volatile lately. But Francine, it does look like financial markets are trying to tell us something about what's going to happen at Wembley today. I normally don't care at all about soccer. I would rather watch grass grow. But this rivalry, to me, has always been very important.
I was going to say, I don't think I've ever heard Matt Miller in the many years I've known him speak about football, but this is Germany against, England, and I know it'll be very, very watched. My husband has actually stopped speaking since France lost yesterday. Now, we'll look at what else is coming up today. Brussels Economic Forum is kicking off with presentations from Angela Merkel, Christine Lagarde, and many others. We'll also get Germany June CPI at 8 a.m. New York time. The ECB Governing Council member, François Villeroy de Gallo, is speaking at the Paris Europlace conference. It'll be a good indication if we hear from all of these central banks and bankers about what they think about inflation. And then the G20 Foreign Affairs Ministers meeting continues in Matera, Italy, always dreaming about the beach and some of these beautiful places where the G20 is meeting. Now, the biggest U.S. banks are boosting payouts and continuing buybacks after clearing the Fed's stress tests. Among the highlights, Morgan Stanley doubling its quarterly dividend to 70 cents. Goldman Sachs actually increasing its payout to $2 a share. Let's get more from Bloomberg's Danny Berger. Danny, the focus on the U.S. and how Europe can match it if they can match it.
Exactly, and that's part of the reason European banking stocks, for a variety of reasons that are idiosyncratic, but because they don't have the same dividend payout, that's why we've seen Europe lagging. A big question, though, heading into the numbers after the close yesterday was how much of this is already priced in. We knew that the stress test was easily passed by all of the banks, but look, just looking at the pre-market reaction, you can tell that investors did not necessarily expect Morgan Stanley Stanley to come out of the gate by doubling their dividend, a $12 billion buyback program. James Gorman really emphasizing the health of the balance sheet. That also compares to a collective 40% raise in their dividend. I would also turn your attention to the disappointing reaction in Citi. Those shares falling maybe only 0.5%, but volume has been off the chain in this market's pre-market trading. They have to boost their capital buffers, which might be part of the reason that they couldn't increase their dividend. They did say they were going to have a buyback program, but didn't announce details. So it really is just two ends of the spectrum. Morgan Stanley, the big outperformer, Kailey.
All right, Bloomberg's Danny Berger with a great roundup. Thank you so much. And from banks to tech, we now want to turn to Facebook. It has hit a $1 trillion valuation for the first time. That's after it won a court ruling dismissing 2 anti-monopoly lawsuits filed by the U.S. government and a coalition of U.S. states. Let's get more from Bloomberg Intelligence tech, media, and telecoms analyst Matthew Bloxham. Hey, Matt, the judge basically said the FTC didn't make a good enough case that Facebook has monopoly power in personal social networking. But the FTC can refile this within 30 days. So this is a fight that isn't over, right?
Yeah, that's right. And there's a whole slew of other legislation that's maybe going through the courts right now, you know, around antitrust. So, yeah, for sure, they'll come back. I mean, all this does is really confirm what we already knew, is that current antitrust legislation, not just in the US, but in Europe, isn't really fit for purpose for these big digital businesses. And it needs some kind of reform to kind of keep them in check.
Matt, you're so close, I could almost touch you, but we're not allowed because of social distancing rules. Does it just mean, I mean, do we understand the full extent of the Biden administration actually, you know, possibly going after these big tech companies?
I think, yeah, I mean, there's definitely momentum behind a clampdown. You know, we've got 5 bills being considered in the House, so I think there's going to be some kind of action. How much power these new laws have remains to be seen. It may well just be that, you know, it becomes a bit like ex post. If Facebook or Apple does something wrong, then they're targeted specifically for that. I think it's going to be a long drawn-out process though before we've got some, you know, clear, powerful legislation on the books.
All right, Matt, thanks very much. Matthew Bloxham, TMT analyst for Bloomberg Intelligence, talking to us about Facebook. Now, I'm so close to my boss here, Chad Thomas, we could touch, and we're both fully vaccinated, but we still won't.
Follow the rules.
I guess, for political reasons. In any case, we could also give each other the Delta variant because we've seen more and more cases of this variant being spread to people who are fully vaccinated. It's a concern for markets. What are we seeing in terms of the spread of, well, it's not new now, it's pretty established, the Delta variant?
Yeah, I mean, we're watching this very closely here in Europe and how this develops. We have Chancellor Merkel calling for a coordinated response on this across the entire EU. Of course, Germany, here where we are, they put in place a 14-day quarantine for people coming from the UK because of the spread there. And Spain and Portugal put in some restrictions as well for travelers from the UK yesterday. Of course, this all comes as we saw the case numbers explode in the UK yesterday, more than 20,000 new cases. One thing, though, we should point out is that, thankfully, the death rate still remains very low. There were only 3 deaths yesterday in the UK. The last time we had more than 20,000 cases there was end of January. On that day that we had that many cases in the UK, there were more than 1,000 deaths. So you see how the death rate has come down because the most vulnerable people have been vaccinated. It's less fatal, but it's still spreading.
Indeed it is. Thank you so much to Bloomberg's Chad Thomas in Berlin. And Chad was just talking about some of the restrictions related to travel. So that brings me to a stock moving in pre-market trading here in the U.S., Carnival Cruise Lines. It is lower for a second day. The stock fell 7% yesterday, although that did have to do with the announcement of a stock sale of $500 million. Still, though, it is down about 1.5% in pre-market trading. And travel by the seas, maybe also travel by space. Of course, Virgin Galactic got approval last week to take paying customers to space. It will cost a lot of money. The stocks surged 39% on that news on Friday, but gave back some of those gains yesterday and is again this morning down the better part of 2% in early hours. One stock moving to the upside, though, is Marathon Digital. Of course, this has everything to do with Bitcoin continuing to gain some traction. The crypto coin up above that $35,000 level this morning. And as a result, stocks like Marathon Digital are higher by about 2.6% before the bell, Francine.
Yeah, Kailey, thanks so much. And we were also talking yesterday about Cathie Wood looking at a possible Bitcoin ETF. So we'll talk about cryptocurrencies shortly. Coming up next, Jeff Yu, BNY Mellon Senior Strategist for EMEA markets. And then a little bit later, Ann-Katrin Petersen, Allianz Global Investors investment strategist. It's a great time to talk about the Delta variant, the impact on growth, and therefore on inflation. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua in London and Kailey Leinz in New York. Now, I've got a chart showing forecasts that may not really surprise you at this point. And to our listeners on radio, we welcome you every day at this hour. I'll walk you through what this shows, but you already really know it. We're going to see strong GDP growth, according to Bloomberg forecast here, 6.6%, and the forecasts have been climbing. We're also going to see strong inflation this year, according to forecasts. That line has been climbing up and now is at 3.5%. The question is, what do these numbers look like out a little bit further, 2022, 2023? And a concern that's growing is that GDP could be smaller and inflation could be bigger. Joining us now is Jeff Yu, BNY Mellon Senior Strategist for EMEA Markets. And Jeff, I picked this out of your notes as a concern. Are we going to see a stagflationary situation as we go into 2022 and 2023?
That really is a major concern for us. And when we go back to the issue about growth right now, we have to consider what's going on with financial conditions and tightening real rates. The Fed is tightening. China is actually thinking about tightening as well. Actually, the language has been quite strong on this if you listen to the PBOC over the past 1 or 2 quarters or so. Hence, we have these supply issues driving inflation higher. We have the 2 largest economies in the world tightening conditions. That isn't exactly the best mix for growth and for sentiment right now. That's even before we talk about the Delta variant and issues like that. So it's going to be a tricky period for the global economy. And I think central banks have to calibrate very, very carefully.
Jeff, given what we know right now of the Delta variant, can it actually put world growth on a different trajectory? Can it bring down, some of our inflation concerns?
I don't think it will bring down inflation concerns, especially if some of the inflation concerns are supply side driven right now. And if we attribute a lot of the supply issues to the pandemic, then that could actually prolong it, right? We are concerned, however, in terms of the Delta variant, more about Asia right now, because we know where vaccination penetration is weak, then the scope for reopening both domestically but also international borders, that is going to be delayed as well. And I think markets are really picking up on that in terms of flows.
Yeah, and Jeff, of course, the reopening recovery narrative has fed very much into the value rotation, but it seems growth has staged a little bit of a comeback. What do you think that picture is going to look like in the second half of this year?
So again, I think the risks are probably balanced, and if anything, they're marginally to the downside right now. Personally, I am somewhat perplexed by China's attitude right now towards growth. I get that they want to keep things stable, and there are ways to manage stability without overtly tightening in financial conditions. If you look at inflation in China, it's actually dropping, and with nominal yields are still relatively high. I do think that real yields are going to be high in China. That's going to be a growth constraint. We are going to see a bit of that in the US as well. So I think putting everything together, if outside of China we still have these inflationary issues, but growth starts to disappoint to the downside, equity markets, no matter what sector you're looking at, I think is going to be in for a tricky period up ahead. And then that begs the question, is stimulus going to be continued? We have the first phase of normalization through tapering, but the next phase of normalization, say rate hikes or that, then see you in 18 months.
Jeff, I'd love to get your take on commodities. There's some talk that we could be in a new super cycle, the 5th global super cycle, or that we are still in an elongated 4th super cycle from 07, 08. What's your take on the commodities boom right now? And do you see a structural supply problem that's going to keep prices elevated or maybe even growing?
I really think it's going to be commodity specific. You were talking about hog prices right beforehand. China is actually so worried about the decline in pork prices domestically that they've actually started buying for domestic reserves, and they've reached what's known as alert level 1 in terms of how pork price declines. On the other hand, they are blaming miners, international speculators, the Fed, loose monetary policy, everything for high iron ore prices, even though they've been trying every other week to tame the real estate market, which should lead to a decline in iron ore demand, for example. Those prices aren't coming off either. So it really is commodity specific. In terms of a super cycle, I don't think we actually are in a super cycle, given how growth is going to come off. But for certain commodities, especially those with a future in ESG, with the green transition, those are going to be in demand for many, many years to come.
Jeff, once the Fed starts to hike, what does China do with monetary policy? Do they stay put or do they need to follow? Is the link between Fed and PBOC broken?
I don't think it's broken. That is a really good question. I think what the PBOC, again, so if the PBOC is blaming the Fed and easy liquidity in the West and for high inflation, high input prices in some commodities, which is driving certain factors of CPI higher, then if the Fed starts to hike and if dollar real rates begin to rise, then conceivably that means commodity prices can come off, and that actually releases a bit of pressure for the PBOC to actively do more to manage inflation as well. So I think they'll be closely tracking what the Fed is going to do. And of course, the exchange rate, a very important part of the situation. If the Fed hikes and that means a renminbi appreciation pressure is going to be a bit more limited, I think that makes their job easier as well. So in some sense, I think the PBOC is actually counting on tighter monetary policy in the rest of the world.
Thank you so much for joining. Jeff Yu there, BNY Mellon Senior Strategist for EMEA Markets. Now, coming up a little bit later today, we are also hear from the Federal Reserve Governor, Christopher Waller. That's at 6:30 p.m. in New York, 11:30 p.m. in London. And this is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Now let's get straight to the Bloomberg First Word News on Goldman Sachs. The former chief executive, Lloyd Blankfein, and former chief operating officer, Gary Cohn, must face a shareholder lawsuit over the 1MDB bribery scandal. Now, a federal denied request to dismiss the suit. Shareholders claim they were misled over Goldman's work with the Malaysian Sovereign Wealth Fund. Goldman has put the blame on former partner Tim Leissner, who has pleaded guilty. JP Morgan reportedly is boosting pay for junior bankers. Now, according to the UK Financial News, the bank is now offering first-year analysts starting salaries of $100,000. Now, younger bankers on Wall Street have complained of longer hours due to the boom in mergers and acquisitions. A German company which makes interiors for luxury cars such as Maserati, or luxury interiors such as Maserati and Porsche, is planning an IPO in Frankfurt. Novem Group is looking to raise about $60 million in a private placement of new shares before the listing next month. The private equity vehicle for Germany's billionaire Brenningmeier family also plans to sell an unspecified amount of existing shares. I want to get Matt's thoughts on this. I didn't know there was a company just to pimp your ride from the inside. And finally, in the UK, house prices grew at their fastest annual pace in more than 17 years this month. That's adding to a growing wealth gap that has policymakers worried. According to Nationwide Building Society, property prices rose 13.4% from a year ago. The average price is now $353,000. I mean, if you look at the UK, this is quite incredible. Just because we had Brexit, many European families leaving the UK, and yet people want more space because of the year we've had last year because of lockdown.
Yeah, well, the same is true in the U.S., right, Kailey? I mean, everybody wants to get out of crowded, dense, urban settings where you can easily catch viruses and out to the country where you can breathe fresh air. I understand.
I would love to breathe fresh air. I live in Manhattan, Matt, so I really do understand that need. But as I live in Manhattan, I will say anecdotally, a lot of people are coming back, and I like to keep tabs on the rental market. Prices are going up, so it's expensive if you want to buy a house. It's also expensive if you want to rent a place. So basically just your cost of living is higher, and that to me, Francine, sounds a little bit inflationary.
Yeah, don't move. I mean, you can't move because everything's unaffordable. Actually, in the UK, I think it's places in the middle of London with bigger garden space. So that's a little bit of a nuance from what we're seeing, these crazy prices at a 17-year high. Now, coming up next,
Kensington, for
Ann-Katrin Petersen, for example, Kensington, but also Fulham. Allianz Global Investors investment strategist. Maybe, just maybe, we'll talk about house prices with Ann-Katrin as well. This is Bloomberg. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Now, there is quite a lot going on, Matt, and we look at the very end to see whether it changes any kind of forecast that we have on growth, and that's filtering through markets.
Yeah, I think that's what markets are most focused on right now, trying to figure out what the Delta variant is, what it can do, and in terms of economic damage, what that's going to look like. Otherwise, you know, there really is this big commodity story, and I'm looking forward to talking to Javier Blas in a little bit, because he says there is a structural supply constraint, or actually two big ones. One is ESG and the other one is dividend payouts that could change the way commodities are taken out of the earth and then priced for much longer than just a temporary spike. So I'm looking forward to that.
Yeah, me too. Kailey, how's it all playing out in the markets?
Well, I am definitely watching commodity markets, Francine, but as for what the picture looks like for other asset classes, it really looks different right now depending on what side of the Atlantic you are on. In Europe, the picture is a little bit more positive. The stock 600 is higher by about 0.3%. Here in the U.S., though, futures are in negative territory. We're only down about 1.25 on S&P E-minis, but it's actually big tech that looks like it's going to underperform today after leading the charge yesterday. In the Treasury market, we go nowhere. We're just sub 1.48% on the U.S. 10-year yield. And in commodities, which Matt was just speaking about, I actually am watching crops because it is very hot in a lot of the U.S. right now. That is feeding into concerns about drought and what the crop supply is going to look like. As a result, spring wheat futures, very important for pizza eaters, are at their highest prices since 2013. And as for some stocks moving in pre-market trading, of course, the big news after the bell last night was the capital plans from big banks after they passed the Fed's stress test. Morgan Stanley, the big winner here in early hours, it's up 3% after doubling its dividend and announcing a $12 billion share buyback. Wells Fargo also doubled its dividend, but only to 20 cents. It's higher by about 1 percentage point. And Citi didn't do anything, left its dividend and buybacks where they were. That stock is lower by 0.4 as a result. And then I just have to note Facebook. For now, it has seen monopoly lawsuits by the FTC and state attorneys general here in the U.S. thrown out. That had the stock up 4% yesterday, $1 trillion market cap company now, and it's adding a little bit of weight to that this morning, up by about 0.25% in early hours, Matt.
Kaylee, I noticed you talk about pizza and bagels a lot.
I like carbs,
So
Matt.
I'm wondering, you're not gluten-free. I'm going to go ahead and guess.
Absolutely not, yeah.
I wonder if being a celiac was a millennial thing, and now that Gen Z kids are coming of age, we can get back to normal.
Maybe.
That could be the case.
I'm a millennial.
Let's take a look at the...
So, Matt, actually, so
I thought you were Gen
Italians,
Z. I'm pretty sure Kaylee is Gen Z.
I am at the cutoff for millennial. I made it.
Oh, so you could still be a celiac. Okay, good. What were you saying, Francine?
The Italians have the highest percentage of celiacs because of the number of pasta they eat. So apparently you can eat it as much as you want and then you saturate. So I don't know if it's an age or whether it's just the amount of what you eat. Dr. Lacqua.
It feels like a fad. It feels like all of these allergies feel like a fad to me. But I'm an old person, so I guess that's pretty normal. I want to take a look at something that isn't a fad, and that is the vaccination rate. We wish it were catching on at a faster pace, but there are a lot of vaccine hesitant sees out there. You can see that the UK, Israel, and the US are all doing really well. And I will say, at least from what I hear out of Berlin, that Germany is catching up really quickly. Nonetheless, the outbreaks of the Delta variant have spurred economies to lock down again. In the case of Israel, even in the case of Australia, you see big lockdowns. And the UK, apparently 20% of those who got the Delta variant were fully vaccinated. So it's starting to worry market participants. Let's bring in Ann-Katrin Petersen right now from Allianz Global Investors. She's an investment strategist there, and ask her take. Ann-Katrin, you know, the vaccinations were such a key part of everyone's strategy, and now that we see a variant that overtakes that, does it concern you?
Yeah, well, risky asset performance and valuations in particular, they have been fast forwarding the economic recovery. And the economic recovery expectations, they depend on vaccinations, the progress on vaccinations, and also the related reopening. Now, will the Delta variant, which is one of the risks to the global economic recovery, but will it really derail economic growth? On a global level, I would say it depends. It depends on the still challenging battle between infections on the one hand and injections, which are hopefully effective against a Delta and any other virus mutations that might come up on the other hand. So on a global level, the economic consequences to date might be limited given the progress in vaccinations that we have seen, particularly in the developed markets. But on a regional level, some countries may fall behind the curve. Those countries, particularly in Asia, that have not made up with their vaccination strategies, for example.
Ann-Katrin, what does it mean for, if you can no longer find value actually in cyclical stocks, where do you look for the next big thing? Do you look at value stocks, or do you have just to look at Asia because they have a better control of the virus?
Well, I think at this stage of the cycle, it is generally advisable to broaden out the portfolio also within equity land. And in terms of regions, we continue to like Europe at the moment, given the expected cyclical recovery, which will at some point outpace or at least last longer than in other regions where we reach peak momentum, such as in the United States. And in terms of sectors and styles, we continue to like value and also financials, European financials, for example, because they should do well in an environment of ongoing reflation, which we foresee for the time being.
Right. Ann-Katrin, you mentioned peak momentum. Of course, we're right now 1 day left in the first half of the year. In the second half, does that mean returns are going to be quite limited?
Well, when I look at return potential for equity markets, for example, I think the source for returns will be rather earnings than any kind of multiples expansion, given the fast forward movement that we discussed already. I think investors, apart from the Q2 earnings seasons, which is about to start soon, will clearly turn their eyes towards the projections for earnings in the second half of this year. And earnings momentum could roll over, as well as economic growth forecasts could roll over, given the very high expectations. So currently, markets are kind of priced for perfection, with analysts embracing the best of all worlds in their earnings and growth forecasts. So against that backdrop, there could be potential for disappointments as we head into the second half of the year, particularly in the United States where peak momentum might have been reached, while there seems to be a bit more catch-up potential in Europe, in my view.
Ann-Katrin, do you buy anything in commodities? Are we in a super cycle, or is it just specific commodities that are going up?
I think there are several factors at play here in the commodities market. We shouldn't forget that commodities currently are also driven by the pent-up demand and also supply bottlenecks. post-pandemic. This is a factor that is pushing up commodities prices. And yesterday, for example, the German import prices came out and they were highest since the oil price crisis in 1981. So that's quite telling. However, these facts are going to fade, and then it comes back to the usual classic supply-demand factors, and we are closely looking at the next OPEC meeting here. Generally, there seems to be a cap to commodities in that sense.
Ann-Katrin, thank you so much. Of course, that OPEC meeting on Thursday. Ann-Katrin Petersen, Allianz Global Investors investment strategist. Now, coming up, from steel to soybeans, commodities are back in fashion for the first time since the pre-crisis years. More on our big take next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua in London and Kailey Leinz in New York. Now, commodities have roared back since the pre-crisis years, making traders and hedge funds billions of dollars. Some are talking about the emergence of the fifth commodities super cycle in modern history as the world economy emerges from the pandemic. How much further does the boom have to run? Joining us now for more is Javier Blas, Bloomberg chief energy correspondent and the writer of today's Big Take. Javier, I thought it was really interesting to read about the possibility of a structural supply issue in that, we're pushing these producers with ESG concerns to slow it down. Plus, we want, as shareholders, more money back in dividends and buybacks, so they can't invest as much. Is this maybe the biggest issue here?
Yeah, certainly, Matt, you are right. I think that supply issue is very important. At the moment, the market is very much focused on the demand side because of the recovery from the pandemic. But what is going to make or break this rebound in commodity prices over the next couple of years is whether the supply responds to high prices. The cliche in the commodity market is that the best cure for high commodity prices is high commodity prices, that just the miners, the farmers, and the oil companies bring new supply. But now we are seeing that because of climate change concerns, and also because shareholders are tired of the underperformance of some of these companies and the low returns that they have achieved. They are telling all these companies, do not invest, reduce your capex, and spend more money paying down debt and higher dividends to the shareholders. And the combined pressure of the shareholders and climate change means that some of these companies have stopped investing. And we have seen this already happening, for example, on coal. Companies stopped investing in new coal mines about 6 years ago. And what we are seeing now is that demand rebounds and we do not have the supply and prices go higher.
Yeah, and Javier, you were telling me, coal prices are at a 13-year high. Javier, who's been benefiting the most? And is it the same people that have benefited so far that will continue to do so?
I think that the people who have been benefiting so far are going to continue doing so. Obviously, we are seeing that the whole natural resources in the stock market is doing quite well after a really bad year in 2020. So the likes of ExxonMobil is up significantly from the lows of late last year and even January. But the people who have done very well from this boom are the commodity traders themselves, the physical commodity traders, companies like Glencore, Trafigura, Vitol, Cargill, some of them privately owned, who are making billions of dollars in net profit out of the boom. And then commodity hedge funds, which were very popular back in 2006, 2008, they kind of disappeared from the interest of investors. They were still there, but obviously not managing as much money. They are having a very good year so far in 2021. In general, obviously some are struggling more than others, but we have seen some commodity hedge funds up 50% year to date. So it certainly is another of the rising bright spots for the market.
Well, Javier, something else up 50% year to date is oil prices. Just focusing on that market for a moment. If OPEC Plus, which is meeting later on this week, adds more supply back onto the market and prices stay high and entice shale players maybe to drill more, what impact is that going to have?
Well, shale companies have been so far very disciplined because they are under massive pressure from shareholders not to react to rising prices. We have seen at every time that a company in America, in Texas, Oklahoma, North Dakota, has announced higher spending, it has got punished on the stock market immediately. So I think that shale companies are going to remain disciplined. Obviously, discipline starts to kind of wind down at current prices, but still we are not going to see a massive increase. And OPEC seems to be in perfect control of this market, keeping prices on a floor around $70. The key question is whether Saudi Arabia is interested in capping the upside, and we are going to get an answer to that question on Thursday when OPEC Plus is meeting.
Javier, is there a concern that actually there's been significant underinvestment in some of these commodity producers? I'm thinking of cobalt and others that are actually critical, as you were saying, to the energy transition, so that we could see prices almost double in the next 4 to 5 years and actually be unable to do the energy transition because of it?
I think that we are beginning to have the signals that the energy transition may be a bit more expensive than we thought. Natural gas, which is going to have to play a big role in the energy transition as a bridge fuel, is getting more expensive, particularly in Europe and in Asia. And then some of the critical metals that we need for the energy transition, including copper, are very expensive. And if the demand increases as much as some analysts are talking about, or some of the traders are talking about, certainly it's very difficult to see copper prices coming down anytime soon.
Javier, thank you so much. Javier Blas, of course, with also a great book out. It came out a couple of months ago, I think, but it's still my summer read of 2021. Now, coming up, charting the post-pandemic future, more on the Bloomberg New Economy Catalyst. That's coming up next, and this is Bloomberg.
We need to not just decarbonize to half of our emissions by 2030, but actually be able to remove up to 10 billion tons of carbon by 2050 to get to our net zero targets and stay below safe amounts of warming. So that's the reason that companies like us really need to ramp up in the next decades to come.
When you're talking about payments and foreign exchange across the African continent, the story is really about infrastructure. So every time you enter one of the 55 markets to be able to make a market in that currency pair or trade cross-border, it's all about having a license, having deep relationships with the banking infrastructure, having connection to the API last mile, and then of course the clients and the revenue. But the infrastructure comes first.
Well, that was the Carboculture Chief Executive Henrietta Moon and the AZA Finance Chief Executive Elizabeth Rossiello on this program a little bit earlier on. Now, these chief executives are among the 31 people on the Bloomberg New Economy Catalyst list. The list highlights those charting the global course out of the pandemic and towards a more sustainable future. Well, Andy Brown, editorial director of the Bloomberg New Economy Forum, joins us now. Andy, great to have you on the program. So this is the idea that you are getting a bunch of people that are extraordinary because they're making a difference in our daily lives, be it climate change, food security, healthcare, or finance, and you put them together to inspire others for more change.
Exactly. Thanks, Francine. Yeah, so this is an extension of the Bloomberg New Economy, which was set up by Michael Bloomberg in 2018 to bring together global leaders from East and West, from the industrialized North and the developing South, to work on some of the most intractable issues facing humanity. And we decided last year to supercharge this effort by bringing together several dozen of the world's best problem solvers, entrepreneurs, scientists, researchers, progressive policymakers. A lot of them are from emerging economies. A lot of them are women. It's an incredibly diverse group, but it's just going to bring energy, vision to our effort.
A diverse group, but what connects the catalysts?
So, you know, when we started looking at the global economy last year, obviously there was a huge amount of suffering, human suffering. 3.5 million, 4 million people have died. We saw tremendous amounts of economic destruction, but what we also saw was this incredible wave of innovation and creativity. Partly it was a result of necessity. In lockdown, people needed food delivery, and so from Lagos to Lahore, you had food delivery companies popping up. You know, also it was need. You had a lot of unemployed people, and they found an outlet in setting up startups. but also it's about technology. That you have a lot of fundamental technologies now, which have been decades in the making, that are ready to deliver these breakthrough applications. And you're seeing that in case after case, the most notable being, of course, the messenger RNA vaccine, which is bringing an end to the pandemic. And by the way, the founder of Moderna is one of our catalysts.
You know, I'm reading here in my notes, Andy, what's the biggest question facing the world? Which in itself is a massive question, right? So, but what do you see it as? Are we thinking about poverty, religious wars, food and water shortages? What is the biggest problem facing the world?
All of the above. Look, you know, I'm gonna go for how do you feed 9 billion mouths? That's the global population mid-century. Without burning up the planet. And, you know, we've got a bunch of catalysts who are working on that very issue. We've got a guy called Justin Gong in China who wants to turn farmers into tech entrepreneurs. Less about pitchforks, less about water buffalo, more about drones and aerial surveillance. We have another entrepreneur called Matthias Muchnik. He's a Chilean, and he's trying to figure out the exact match in the plant world for animal-based food. Who knew if you combine pineapple and cabbage, you get the taste of milk?
I had no idea. Just don't put it on pizza if you're Italian. Andy, thank you so much. Andy Brown there. And of course, the Bloomberg New Economy Catalyst starts June the 30th. You can register online now for the neweconomyforum.com/catalyst. We're also looking forward to having the Moderna chairman with us tomorrow about the same event. Now, let's have a look at what else we're watching today. And Kailey, you're looking at the heat wave in the U.S.
Yeah, and feeling it also. It is really hot here in New York, Francine, but it's even hotter in places like Portland, Oregon, which hit a record 115 degrees Fahrenheit yesterday. That is 46 degrees Celsius for those of you who use the metric system. That has started to trigger rolling blackouts in some areas, and also it's feeding into concerns about droughts and bad crop conditions. So this does also have a market implication, Matt.
Hey, I'm looking at, I'm going to actually watch soccer. England versus Germany tonight is going to be amazing for so many reasons. Number one, it's in Wembley, and they're going to be like 55,000 Brits there and only 2,000 or 3,000 Germans. So that should be pretty awesome. Number two, usually, obviously, Germany wins. Our German producer is one of them. What? Right. So usually Germany wins, although England has had some famous victories, 1966 to win the World Cup, and in 2001, I think they beat Germany 5-1. But it could go either way tonight.
Yeah, I'm watching the G20 Foreign Affairs Ministers meeting in Matera, Italy. Now, we're just getting actually a headline from the Chinese counterpart saying that G20 nations should avoid negative spillovers. Of course, he's talking about the economy, but, you know, the foreign ministers of the world's most influential nations are meeting to discuss the fight against COVID. I know they'll talk about the Delta variant and how to speed up the recovery to the global economy. We'll have plenty more on that shortly. This is Bloomberg.